To Money Watch now, and as we begin to turn the page into April, we are looking back on a roller coaster March on Wall Street. To sort all the things to come, we turn to financial expert Chuck Zodda, the Chief Investment Officer and Managing Partner of the Armstrong Advisory Group. Chuck, thanks for joining us this morning.
Absolutely. Thanks for inviting me.
Let's start with the Trump administration's tariffs. Uncertainty caused a massive drop on Wall Street in the past few weeks. Stocks have somewhat recovered, but what could we be in for another big swing next week when the president is set to begin a new set of tariffs?
Well, I think this is one that quite honestly could go either way, simply because we don't know what the scale, magnitude, and implementation of these tariffs may be. So that's all going to be announced on April 2nd, according to the president. And so we have a couple different paths that this could take. Obviously, we could, see a more lenient path of tariffs where the market says, OK, this isn't as bad as we expected, and maybe rallies a bit in the short term. You could also see one where it maybe comes in a little bit harsher than anticipated. And so you have a sell-off there. But I think the big thing on any of this is, look, markets have been preparing for this for a little while now. And so there's a very real possibility that there might not be too much movement in the short term, just because we've already had, a fairly decent sell-off in markets. And I think we're kind of looking to see how these start actually impacting the hard data that we're getting over the next couple months, as opposed to simply the announcements being the driving factor behind how markets are moving.
So what do you expect to see from the markets in the next week or so?
Well, I think it could be quite choppy. I mean, there's the potential for this to go, any number of different ways. And the other thing that you have to remember is we're also going to be getting a significant amount of economic data coming out next week for the month of March, including a jobs report next Friday. So that's something that has the potential to cause some volatility in markets as well. So while this week has been fairly calm and somewhat of a recovery from what we saw in the first half of March, next week has the potential, to see a little bit of volatility returning to markets, depending on what's announced and exactly what we see in the data we'll be receiving.
And we keep hearing the word recession right now. A new report just came out saying that consumer confidence is at a 12-year low. Is this just noise, or could it be a real fear?
Well, I think what we're seeing right now is fear that's being represented in a lot of the surveys that are out there. You mentioned consumer confidence. There are also a number of surveys of business leaders, whether CEOs, purchasing managers, a whole bunch that we get on a monthly and quarterly basis. And they're all telling us the same thing, that people are pretty downbeat about the prospects over the next 6 to 12 months. But the question that's looming out there right now is, does that downbeat sentiment turn into actual hard data that weakens? And to this point, most of what we've been seeing over the last month or two hasn't represented a huge divergence from what we had been seeing previously. So this is the question that I think is going to be answered over the course of the spring and into the summer, which is, hey, we've been getting, this downbeat sentiment for the last couple of months. Does it start to actually print in the hard data that shows fewer people being hired, fewer cars being bought, fewer homes being sold? Those are the things that we'll need to see over the next couple of months to determine, hey, is there a recession that could be coming, or is this just some noise that's not going to really materialize into anything meaningful?
Will be interesting to see. And what can we expect from this week's expected report on inflation?
Yeah, so what we're going to be seeing this Friday, it's called the Personal Consumption Expenditures Inflation Index. It's the one that the Fed really uses to help determine how they're going to set their interest rate policy. The expectations are for the monthly number to come in at 0.3% and the annual number to come in at 2.5%. Both of those in line with where we saw them in the prior month. So not really a huge shift on inflation expected here. But remember, the data that we're getting later this week, it's for the month of February, which is before additional tariffs were imposed on Mexico, Canada, and China, the three largest trading partners that the U.S. has. And so obviously the March data that comes out a month from now could be significantly different depending on what we're seeing in that data there. So I think this is one where, sure, we have a pretty good expectation of what we're going to see, but it's already kind of outdated because policy has changed since this data was collected.
And for so long, tech led the way in stocks. That's fallen off in recent months. Is there another sector you're seeing right now that's getting more bullish?
So the two sectors that are best performing year to date so far are energy and healthcare, which are kind of strange bedfellows. And that normally, energy is something that, hey, when the economy starts to rally, you see energy stocks rallying with it just because the price of oil tends to move up. And so you see energy stocks able to generate more profits. On the other hand, healthcare is typically a sector that rallies when the economy, or not necessarily rallies, but performs better when the economy is slowing, simply because people still have to go in for required procedures and treatments and things like that. And so it has a little bit more stability than other sectors of the economy. So we're kind of getting mixed messages from the market right now in terms of where the economy is going. And I think that's just another sign of the confusion and uncertainty about where the next 6 to 9 months go in the economy, is that you've got two sectors that typically do well in very different economies. They're both rallying right now. What does that mean? I think it means we need some more time to sort out exactly where things are going.
Chuck Zodda, always informative with the Armstrong Advisory Group. Thank you so much for joining us today.
All right. Have a great day.